Good morning and welcome along to another episode of Beyond Bitcoin. My name is Deryck Graham and here we are, of course, with my friend and colleague Nitin Gaur. Hey Nitin. And this week, which is the macroeconomic discussion week, third week of each month, is Mark Witten, the CIO of Portal Asset Management. G'day, Mark.
Hey, how you doing, guys?
Good to have you again, Mark. Looking forward to this rich conversation.
So as the listeners know now, you guys are getting a market deep dive in the second week of the month, and that's from Greg Galton, who is our senior analyst and thorough lover of all things crypto, but also with 20 years as a disciplined equity analyst. And with us today, of course, Mark Witten has more than 20 years as a fund manager, and a lot of that is driven by macroeconomics. And as you always say, Mark, the macro drives the micro. And that's what we want to discuss this month. Since we caught up last month, the market's gone from being really, in April, thoroughly bearish to, in May, thoroughly bullish. How has it done such a turnaround so quickly?
Thanks, Deryck. So from our perspective, there wasn't anything specific in April that led to the sell-off, particularly in the crypto space. You had a little bit of news around CZ and Binance getting a slap on the wrist. There was a bit of a concern around the fact that maybe inflation wasn't coming down as fast as was expected. But there was no real, there wasn't some counterparty risk like an exchange that had run into difficulty. I think there's been this constant geopolitical risk, the conflicts we're seeing in Eastern Europe and the Middle East starting to increase in intensity in some ways. And that's always concerning because, it can quite quickly, mushroom out. I think what turned in the last couple of days, because the markets felt very illiquid, like there was a lot of quite severe price movements, but on not much liquidity. And then I think what we started seeing is the expectations of, number one, interest rate cuts coming sooner than expected. I think we're firmly behind the curve, where we should be right now. We were expecting rates to come down from the sort of 5%, 5.5% in quarter one this year. They should have been cutting already, and we were expecting over the next 12 months around 2.5% to 3% of cuts. So we would expect the Federal Reserve rate to drop to around 2.5% to max 3% by the beginning of 27. But that would be a very measured approach, and the Europeans are having the same view. I think that they're in a little bit more of almost a more difficult position because a lot of what you're seeing is not real GDP growth. You're seeing a lot of the effects of demographic shifts into developed countries, and there's not a real underlying consumer demand driving inflation. It's mostly focused on housing prices to an extent and food, fuel, and energy, but it's not through demand. It's just through more people in a certain place. So that's the first thing. So I think number one, we had three big macro views. Number one was that rates were going to come down quicker than expected, so there'd be more liquidity. So that was a headwind, which now become a tailwind. Number two, we perceived that the regulatory environment, the framework, particularly in the US, would start showing some clarity going into an election year. We have the incumbent Democrat being less crypto friendly, but both the independent and with RF Kennedy and the Republicans tend to be a lot more crypto friendly. And I think that was our second thesis. And then, the third thesis was that more institutional adoption and investors would arrive, particularly once the Bitcoin ETFs were approved. And now we're seeing, the fact that it looks like the ETH ETFs are being sped up. And the final thing I'd say on that in terms of what changed month to month, the only thing that I can really pick up that changed, which is very important. If you look at the clinch almost for the launch of the Bitcoin ETFs was the description of the SEC's actions as arbitrary and capricious by the judge when Gensler refused Grayscale's application to transform the trust. And now the SEC is actually, from what we understand, CoinDesk has reported, is that they're asking the exchanges to update their filings for spot ETFs. In other words, they look like they might be trying to hurry this along. And then there's been a couple of, interesting tweets and things like that have kind of fed into that by saying, look, people are getting longer. And then it becomes like a self-fulfilling prophecy. It's like buy the rumor, sell the fact. So we've been well positioned for this. We had a difficult April, but a lot of the positions we had in the AI space and some of the thematics hurt us, but we're well positioned for this month. And we firmly have seen the macro calls we've had play out and continue to play out. So we're very much comfortable on our macro, and now it's just a case of managing the volatility and the risk in the short term. If that explains it in enough detail.
Yeah, very much so. And one thing we have seen in this very short period of time is we of course saw the maybe rumor that this, or the expectation that this request for filings would see an ETF appear. It's interesting, Mark and Nitin, how quickly and positively the market responds to it. One thing I find when I look at markets like that is if a market responds very strongly to positive news and in a muted way to negative news, you can see where the market is trending. And in this case, we saw really Ethereum go up nearly 20%. We saw Uniswap go up 34% in just a matter of days. And we see the market, and we're talking, of course, the recording night of Tuesday for this, the 21st, and we've seen the market, rise in the case of the CCI 30, some, close to 19 and a bit percent since the beginning of the month. So I think the market's predisposed to receive positive news at the moment. What are your thoughts, Nitin?
Yeah, so I think just to add to what Mark mentioned, geopolitical issues, there was a whole conversation where this week alone, a few countries like China, Philippines, and Thailand, and Australia, including Australia, where you live, Deryck, did not change the rates in favor of observability of inflation data, which is a positive thing because at that point, there's some level of predictability in the way the global macro behaves, which brings, which to me, and I'd love to get your perspective on this, Mark, is one way to bring liquidity in and out of crypto markets. So if you look at the entire crypto market, Deryck, it's priced in US dollar. So US dollar weighs in heavily, both in terms of money supply, but also in terms of any tightening efforts. So the last FOMC meeting, when they opined on CPI and later then they had the PPI numbers, which reflect upon overall inflationary data, the concerns were twofold. One was the US debt, which has reached $1 trillion in interest rates alone that the US is paying. And second thing is the debt to GDP ratios, which have been quite high. And the concern there was, can US sort of either increase its taxation or be able to cut down on costs or in terms of spending, the government spending, which leads to overall the definition of US dollar as a fungible instrument across crypto ecosystem as well. So I think one thing I'd love to, which we've discussed on this podcast, Deryck, is ability for crypto to decouple. And if not, then the impact of US dollar markets in general with how it relates to crypto markets as well. That is an important point because I think a lot of pricing in the crypto market is done via US dollar system. So I'd love to get your position that, Mark, that because of that tight sort of coupling, there's a lot of dependency on global macro on the way price movement and the crypto markets move, which is never the intention, but it's where we are now, I think.
Yeah, no, that's very, very true in that, one of the big themes that we've been focusing on is the continued debasement of currency. Currency is like any other commodity. The price of currency, or the price of money is interest rates. So the US has been, on the spending spree since COVID. It had a bit of a spike after 2008, and then you saw the, what's it called, the target asset repurchase programs in 2014 and so on. But then it was being managed. After COVID, you have unlimited QE, which kept rates unnaturally very low. I think the trigger or the turning point, which was, I still kind of can't make heads or tails as to why they would have, why NATO would have done this, was when Russia was ejected from SWIFT, because it then forced whether it's Russia to trade with its neighbors, but it also put a big question mark around the sustainability of the petrodollar. And that has caused a lot of uncertainty in US dollar weakness. Sure. So you're seeing less appetite for the for US treasuries. And what you were talking about earlier is when governments believe there's too much liquidity, or the US government, the Fed will sell bonds, which pulls liquidity out of the system. So you get to hold bonds, but you're giving up cash. And when you're seeing other countries doing it, they could be, like you said, China and others. They are either having less confidence in the ability of the US to pay its debts, or they're raising liquidity for internal spending to stabilize. There's a multitude of reasons. Either way, I think you're right in that it does give us concern, considering globally all markets, not just crypto, all securities, whether it's oil or whatever you want to think of, is priced in US dollars. So our theme in terms of continued debasement of currency and crypto being a beneficiary of that as a store of value, because there's no more Bitcoin just being minted exponentially. There are some concerns around some of the other tokens, but I think by and large the ecosystem there's no backstop, there's no bailouts for crypto tokens or for exchanges, or so it's a very self-regulated industry. I think the second thing I'd kind of say on it is that so you have this debasement, that's one thing, and the technological innovation which naturally comes as the other thing. And then you've got a much higher, I would say a higher quality of investor that's been coming in, that's adding liquidity. And a lot of that money, there's different segments or durations. You have short-term speculators and arbitragers, you have day traders, you have people that buy and hold, you have people that, the moms and pops who might say, I'm just going to buy a Bitcoin and put it in the bottom drawer. But now you have pension funds and insurance and big institutions, endowments, university endowments, and they have to have asset and liability matching. So their time frame is way longer. And family offices as well have multi-generational kind of projections. And I think that's what you're starting to see now is when, as Deryck was saying, there's like the bad news isn't causing this massive sell-off. So you've seen the volatility over the past year, the vol, as the market cap's gone up, the vol has come down. And generally when the vol gets to a low enough level, that was in our last commentary, and it's based on some of the studies done by Fidelity, it's like a spring, and Raoul Pal called it like a beach ball being held underwater. And what I'm saying is some of those headwinds, like the ETH ETF application, the regulatory environment, plus the fact that rates are coming down. Like I don't know why they haven't come down yet. They should have been coming down. The world then it's not in a good place. The consumer is not in a good place. Governments are not in a good place.
So one follow-on to that, Mark, a scenario for you, and this is something which I read in this Galaxy Digital report that you shared with the team the other day, was around the fact that a Kobayashi letter, which talked about the fact that since 1800s, 51 out of 52 countries who reached 130% of debt to GDP ratio have defaulted, according to the U.S. Congressional Budget Office, right? And the U.S. is reaching 120%. This goes back to your earlier comment on the concerns around debt levels and the fact that interest rates where they are today, the idea for them interest to drop is not just for the consumers, and the impact of easing in that liquidity is also for the U.S. government, because suddenly their interest rates, interest payments on that debt goes down, and that allows them to be able to, make corrective action. So that's one scenario. The second scenario is the geopolitical elements that you mentioned. There was a meeting last week between the Chinese Premier Xi Jinping and Putin in China, and that led to a lot of conversation on Twitter in terms of the ability for Chinese central bank to be able to offload some of its U.S. debt onto the open market, and an Indian central bank, this is the BRIC nation, looking into this in terms of procuring gold instead of U.S. Treasury, which was a safe haven. So you begin to see this small movement, which certainly has impact on the overall money supply. But the last thing I would ask and pause, Mark, is then you have sort of the stablecoin conversations becoming alive, only because stablecoin is seen as a new avenues for the world to consume the US dollar in general, which has been quite favorable in the last 1 week. And the crypto Twitter has been opining to say, hey, is the US regulatory apparatus and the congressional sort of folks are more favorable now because of the geopolitical elements? So if these two scenarios play out, where do you see the crypto industry sort of moving suddenly now? You see that strengthening as the dollar sort of strengthens, or do you see crypto sort of bypass that whole and be its own? For example, you start seeing the crypto macro in general being priced in Bitcoin itself. I know it's a bold question, but I'd just love to get your thoughts on that.
Well, there's three things to kind of unpack from the question. So the first is, you spoke about this sort of budgeting sort of bromance between Putin and Xi, and they had a hug and everything. And
they did have a hug, yeah.
Yeah, there's the rise of the BRICS, which has been on the cards for a long time as an alternative currency. The difference in terms of countries getting to 130% and the US dollar being the reserve currency of the world is when they print money, they don't create inflation on the dollar, they create inflation elsewhere. So they export their inflation, right? Because no matter what you're buying globally, it has to be priced in dollars, as per the Bretton Woods Agreement. That is what's under threat. And people say, well, there's nothing backing the US dollar, but there's a very large military backing the US dollar. If anyone tries to change, they tend to get a knock on the door. So there's those two things. But the US has been in sort of militarily and otherwise in decline. And you have seen the rise of what they call the Asian super empire over the past 20 years. And this has just been demographic shifts, technology, copying, there's many different reasons. So when, like at this point, China, and particularly if it's backed by the likes of Russia, India, and Brazil, and South Africa, are kind of like almost moving into a place where they're on par with the US. So now it's like there's going to be this friction. And one of the ways wars are fought is economically, which is to destabilize countries economically, to disrupt supply chains, that sort of thing. So I think, without getting too deep into that, I think, number one, that's still got a long way to go. It's going to take a long time before you see a valid replacement. But crypto does, as for the first point, crypto very much fills it fills a gap. Because if you're sitting in the US or in China or in Russia or in places like, unfortunately, Gaza or Ukraine, and you have capital, you're worried about your bank account, you're worried about being made to go on the, you have a place to put your money. And this is not just in countries that are going through turmoil. In South Africa, you have capital controls. Now, people are using, as you said, USDC and USDT to not so much bypass, but they're able to put cash via South African exchanges into these, and they basically have a proxy for the dollar. It's like an asset swap. So I think that's the first thing, is that, and I was saying to Deryck before the call earlier, it's very difficult to control market forces. When you start trying to manipulate things, and the market wants something, the market tends to find a way to get it. So, the market has told us that they wanted Bitcoin ETFs and they wanted Ethereum ETFs. And it's not just the US, it's globally. And it's caused a bit of an about turn, whether it's in Hong Kong, and now you have Australia following suit. So I think that once you have the demand there, as they say, when bankers only really advise their clients what the clients tell them they want, right? So the banker will say, well, the clients come and they say, well, the generation that is now sort of taking over some of the wealth, the boomers' wealth, let's say, are in their 40s and 50s, and they're saying, we want access to crypto, but we want to do it in a regular, proper way. We don't just want to go and do it in a way that it opens us up to risk, particularly from a tax perspective. So that's why I think you're going to get these ETFs, and they're going to be approved, particularly on the ETH side. And there's going to be rafts after that. You're going to get DeFi ETFs. You're going to get like every flavor you can think of, just as you can get every flavor in the world of, let's say, equities or fixed income. I think to the sort of final part of your question is, and it's not just because we run these funds and inherently we have a kind of a longer term view that we're very bullish on the market as technology and adoption and the network effect kicks in. But I think it's also just a case of how much liquidity has yet to flow into the space. So a lot of investors have 4 or 5% allocated to gold. Our view, and I've always been on the conservative side, I always try to be conservative on the long side, is to say, well, my view is at least 3% of assets held by family offices, retail, and traditional sort of, the smaller investment banks and pension funds, 2 to 3% should be held in crypto. Most of them have zero. Some have maybe 0.5%. There aren't many funds that have. So I think the liquidity flowing into the space is really going to take valuations, way past what most people think, because there's a finite supply, particularly of the likes of Bitcoin. And I think as much as there's a lot more ETH, the burn rate there also makes it deflationary. So it's a store of value, it's the geopolitical risk, it's the transmutability, it's the fact that the banks, I'm very concerned around banks. Like there's massive stress on bank balance sheets. You saw it here,
Sure.
with Credit Suisse. That was like something that theoretically would have been unthinkable. I mean, that was like the premier Swiss private bank. It's gone. And it was bailed out by UBS, which is many times the Swiss economy. Their assets are like, it's kind of like, does the Swiss National Bank answer to UBS or the other way around? And that's kind of like what you're seeing in the US. You're seeing it globally. So I don't know why rates haven't come down, particularly in an election year. They should. We have the liquidity effect. We have the technological innovation. We have more people. We have demographics. Like everything is pointing, and continued debasement, to like this being a proper secular bull run, not a cyclical one. Like, and we just need to be aware that at some point, everything comes to an end, right? As the saying goes, all good things must eventually be burnt down for the insurance money, right? So it comes to an end. And when it does, it's like there's going to be a massive correction. But how many corrections have we had where it's like it does this, comes back 20, 30, 50, and then makes new highs? Compare it to gold over a 10-year period or any other asset class. Like the rest of them look like they haven't moved. And the crypto market is like, and we haven't even, I believe, really begun to see the applications come through. We're starting to see it slowly. There's some really interesting applications come through that have been developed for the past 2-3 years. They're now coming to light.
So look, this actually brings us to this discussion, the fact that our view is that liquidity is being loosened, it's becoming available through multiple different sources, and of course we know that all things crypto assets thrive on liquidity. So there's a certain correlation to liquidity. And we saw that slight air pocket in April where everyone gasped for there was a moment they thought liquidity would actually be tightened up. And then clarification came, and the May period of time now, the market's moving forward. And as I said, just looking at these various fund structures, I know that the CCI 30 is up nearly 20%. And so what we're seeing is this release of liquidity. What we're seeing is the new technology of Web 3.0 appearing. What we're seeing is decentralized finance working better and better. What we're seeing is ETFs coming on board with Bitcoin, possibly Ethereum, then you'd imagine Solana that will follow. All of these events where liquidity is brought into the market. And so much so that this is the reason why we continue to be thoroughly bullish about where this market's going to be going over the next 12 to 18 months. And I think a lot of people look at that and figure that at the end of that 12 to 18 month period, there's now a cliff. Like there's a guaranteed cliff and a crypto winter. And it's interesting to note, if you look at the volatility of Bitcoin, which is about 0.85% of the market volatility, so to speak. If you look at that, then you realize that Bitcoin's first peaks and troughs were like 5,000%, then 1,500%, then a drop again. And so you're seeing the volatility drop out of the market. I'm doing an article on it tomorrow on LinkedIn, just showing how the volatility is dropping out of Bitcoin progressively. Well, so is the volatility dropping out of the crypto asset class progressively to these levels. And maybe that shows a maturation. But it also might suggest that there isn't a crypto cliff at the other end of this liquidity drive that we're going to see. As you say, a secular growth in this marketplace, not just a cyclical growth in the marketplace. But either way, a good investor should have some thoughts about how to prepare for that, how to get a solid rise on this market, but then how to, as we use the term, ladder down and be in a position where their investment is able to benefit from or at least be neutral during the crypto winters that come. You're the fund manager. Maybe give us some tips on that, Mark.
Sure. So managing risk is always, it's easy in hindsight, right? To say, well, we should have been or should have had. But, you can size it at a comfortable level, which to me is between 3 and 5%. I think from sitting on the other side of the table, managing a fund in the crypto space, which is very volatile and moves much quicker. So like a week ago, you saw people thinking, Bitcoin was going to go to like 50,000. It was trading at 60. Now it's back to 70. So like almost 20% in less than a week today. So it's hard to kind of, in some ways, it's almost better to trade counter-cyclically. Depending, you stay in, what we've done is we've stayed net exposed to our longer term view that this isn't going to be like a short rally. It's an actual step move up in both demand. So the supplies come down, demand is really starting to go up. And as there has been more certainty, a whole raft of new individuals and new players globally are coming in, and there's not like there's a finite amount, that can be allocated, that can be absorbed, so to speak. So from our perspective, what we've done is when we placed ourselves in the middle of last year, we said this was, we were pushing and saying the bottom of the market was in quarter one, quarter two, 2023. You should be getting long the market. And we did that. We shifted our funds away from the market neutral, less vol strategies, lower vol, into the higher vol strategies. And that's played out really well for us, in particularly quarter four last year and the first quarter of this year. April was a bit of a snapback, but we very much have that net long exposure. We believe in that. We don't think it's time to take that off. What we'd like to do, though, is you want to balance out. So you want to take some profits. When I look at Radiance, we've had a big bet thematically on AI, and that did exceptionally well. So we can maybe take a little bit off there. There's also the ability to reduce your net exposure from, let's say, 80-90% net long down to 60-70%. The challenge is generally, if you go back and look where the money is made in a market, if you take it over a 5-year view, it kind of looks like it does this because the trend tends to be up and to the right, but it's actually only a handful of days in the market, a day like today. If you weren't net long and you're now scrambling to cover short, even worse, if you're a short and you're scrambling to cover shorts, like you often get whiplash because it'll do a day like today and then it'll come back, but then it might carry on pushing up. So
That's fine.
timing, timing is timing the market. Like I always say, and it's a joke, but it's kind of the truth. It exists to make astrology look respectable. Like you might as well just make up your own rules as to, it's like, oh, today the temperature's whatever, so I'm going to buy. Like it's not scientific, it's not replicable. But doing the work and saying we believe in these macro thematics, we look at the on-chain data. It's not like we are guessing that there's new individuals. It's not like we read the publications. We see the hedge funds that are getting involved. We see the Japanese government. We look at what Gensler and the rest of it. Like we know what the basis is, and we know that the upside, the risk, is way more than the downside in the near term. How do you manage that? Well, it's diversification. I wouldn't have 80% of my fund in Bitcoin or Ethereum because that second order effect could kick in. And the next thing is you see the alts rally 200% and Bitcoin stays flat, which is done in the past. Maybe not 200, but it has lagged. And then secondly, I think, you manage your as you say, your pin risk, your position sizing, your net and gross exposure. So you don't want to be you don't want to be leading the pack in terms of vol, and you also don't want to be market neutral. In this space, it doesn't pay to run more than one strategy. And our strategy is net long, no real gearing, and position sizes are kept quite small. So sometimes we miss out because we only have 3% in Fetch AI, that almost doubles. We could have had 10 in there, but at the same time, we know that that's where the blobs can come. When you see an FTT go to zero, it's a binary thing. And the last part of your question, Deryck, the last thing I'd say on it is, when do we expect the cycle to turn? Well, I don't have a sort of prediction as to the dates and the times, but what I think is, unless you see a real escalation in geopolitical risk, which, like I said, could be good for the space as people look for alternatives, flight to safety, other ways of managing liquidity and saving money. But I think it's only when you see inflation start to bottom and turn, when you have rate expectations kind of back at their lows, and you're going back into a tightening cycle. When you see the debt part of the equation of growth start looking a bit worrying, then I'd say it's probably time. Or if they kind of come in with like massive overregulation, which I don't think is going to happen. Like that was Operation Choke Point 2 years ago. Now we're in a new world. Politicians, it's an election year here in Germany, UK, the US, etc. Like there's definitely a push towards, consumer-friendly policy, should we say?
I believe 75% of Global South is going to go through an election year this year, Mark. And I think there's so many things to unpack, which I don't think Deryck will have the time for. But eventually, at some point, Deryck, I'd like to bring Mark back and talk about, I've been spending a lot of time on collateral management. As you know, Mark, it's a significant infrastructural element of the existing financial markets, but that is practically non-existent. And how do we deal with that, both in terms of derivatives, but also in terms of the transmission of collateral, which is such an important part of borrowing and lending that happens, which is non-existent, and love to understand the impact of that. Also, information. I think if you look at the difference between the equities and bonds, which is largely informational and structural, that distinction is missing because largely it's information-driven market. So how do we consume that information? What is that? So I'd love to spend more time on that at some point, Mark. But this is brilliant.
Nitin, just a question from my side. Like, I know that there aren't that many people in the traditional world of finance, and I don't claim to be one of them, but I don't think there's that many people who really understand sort of the plumbing of the industry and how the collateralization works, how derivatives work, and so on. And then I think if you take that
Yeah.
number of people, okay, and then you say, okay, how many of those people really understand blockchain, really understand, how the exchanges work, on-road, off-road, like on-ramping and off-ramping, sorry, and cold store. Like, I don't think if there's a handful of people globally that really get that intersection. I mean, I know I've still got, many, many, many moons of work to do to catch that up, because obviously it changes very rapidly, and the liquidity and the
Yeah.
new products and the leverage that's inbuilt and inherent and so on. But there is a massive gap. I agree with you in terms of what's coming, not just from a traditional finance point of view, like some of the products on staking, lending, yield, insurance, etc., etc. We're talking about AI, and then we move on to what's the next, what there's already thematics coming after that, AGI and others, ACI, like so it's moving very, very rapidly, and I think not many people really understand sometimes the risk, but with massive risk also comes massive reward. And a lot of what we're seeing today is just a lot of the volatility we're seeing today, I think, is just shaping, the future generation of products. I don't see how some of the big behemoths are going to continue to, I mean, they're all ex-growth. They might control the internet, so to speak, but they definitely don't control the innovation that's coming from Web3.
Absolutely. I fully agree. And that's the whole thing to, my work and I'm actually in San Francisco today, so it's early morning. Thank you, Deryck. But the conversation, Mark, is around exactly the same things. Like, are we mature enough? Do we have the right infrastructure in place? Are we doing all the right things and these are like mature conversations. But there's also another aspect, which I think, Deryck, you mentioned, of the degen element of it, which is also an important part of the industry, which we cannot ignore. So I think we need to have more of these conversations to not only educate our audiences, but also educate ourselves and be on top of our game as we are sort of going through this adventurous journey of ours.
Well, very good. And I've got to say that I regularly get the question put to me, why should I invest in this new space? Why? I don't understand it necessarily, and I'm trying to learn. Well, there's no question about knowledge asymmetry, and that is that, there's a small section of the population that has a great deal of knowledge in this. But why? Really simply, because this is a massively rapid growing new technology that's going to play a significant, if not dominant, role in what commerce is going to be over the next 5, 10 and 15 years. The generation that's coming, we interviewed him the other day, Golden X, that generation that's coming, they're not looking to buy gold. They're not looking to open a check account. They would never seen a check in their life. They wouldn't know what one is. Their rationale of thinking is totally different to ours. This technology in this space is waiting for them to arrive. The question that I always look at is, would you really invest in a traditional old school banking structure, or would you invest in the most rapidly growing new technology industry that exists in this space? And I know it's biased, but it's pretty obvious, really. So it's a matter of people that are listening, coming up to speed, just learning as much as you can. Don't be overwhelmed. There's so much information out there. Just learn what you can. In fact, we've just recently completed a book called The ABC of Blockchain. And very shortly, I'll make this available to everybody via our website. We'll also be able to put this on our Beyond Bitcoin links, etc., so that people can just get the basics of how this works. And most of the time I've discovered that people have fairly big aha moments once they've read through, some basic introductions to the space. Mark, thank you so much. We've run a few minutes over time, but this is always an incredible space because it's where macro, crosses across to crypto, and really this is where this is where the action is.
I could speak to Mark for hours on this topic, and I think we should probably have one day when we can just speak for hours without actually having to have any time limits. Of course, the audience get bored because no one has that kind of time. But Mark, thank you so much for coming and sharing your perspectives. And Derek, if Golden wants to see a check, we still use checks in the United States, so I'll mail a copy so he can understand what it's for, how it works, and so on and so forth. And what's up with shilling the ABC of blockchain? You should be shilling my book.
Good on you. We'll see you in a month's time and to continue the macro, and we'll see everybody else next week. Look after yourself, both over there in Germany and in San Francisco today, and we'll see you next week. Bye for now, everyone.
You too, Derek.
Have a great week.
Bye.
Cheers, guys.